Is this the Bitcoin bear market blues moment of the year? Bitcoin doesn't feel exciting right now, and that's exactly why this moment matters more than most people realize. This isn't fear-driven selling. This isn't euphoria-driven buying. This is something far more subtle and far more dangerous for people without conviction. Boredom. The kind of boredom that creeps in after months of sideways action, after headlines stop shocking you, after price stops rewarding emotion. This is the phase where people quietly give up, not because they're forced to, but because they convince themselves nothing is happening. And historically, that exact mindset shows up not at cycle tops or bottoms, but during the long compression phases where the next major move is being built quietly, patiently, and without applause. When markets go silent, structure speaks. And right now, Bitcoin's structure is telling a story most people are ignoring. These next moments could be absolutely massive. So I need you, the amazing viewers, kick back, get comfortable, smash the like and subscribe button. Now, let's get right into the video. What makes this period feel especially heavy is that it doesn't resemble the kind of bear markets people remember emotionally. There was no explosive alt season leading into this. There wasn't a mania phase where microcaps went vertical and punished late money. Instead, this cycle rolled over from exhaustion and indifference. That changes how the psychology plays out. In past cycles, denial dominated early, then fear, then capitulation. This time, acceptance came early. People who lived through 2022 aren't pretending it can't happen again. They already know it can. That awareness removes some of the emotional volatility, but replaces it with something slower and quieter: disengagement. And disengagement is what creates extended grinding phases where price bleeds not because sellers are aggressive, but because buyers stop caring. The 4-year cycle still matters, whether people like it or not. It doesn't dictate exact price targets, but it frames expectations. Historically, Bitcoin peaks into post-halving liquidity transitions and then spends months unwinding excess optimism. This cycle aligned with that again, right as quantitative tightening approached its end. That timing isn't random. In 2019, Bitcoin topped before QT ended and continued lower even after tightening stopped. Liquidity didn't immediately rush back in. The system needed time to rebalance, sentiment needed time to reset, and price needed time to compress. The same setup exists now. QT ending doesn't mean instant upside. It means the headwind stops worsening, not that the tailwind starts immediately. One of the most common mistakes traders make in these phases is assuming symmetry. They expect the market to behave exactly like the last cycle, but markets don't repeat cleanly. They rhyme with variations. In 2022, Bitcoin rallied sharply back to its bull market support band before breaking lower. That rally was powerful, emotional, and convincing. This time, the rally attempts have been noticeably weaker. Smaller percentage moves, faster rejection, less follow-through. That difference matters. Weak counter-trend rallies often signal that the market may choose a different order of operations, potentially sweeping lows first before allowing any meaningful relief. When you look at comparable structures across other assets, this pattern shows up more often than people realize. You see an initial low, followed by distribution, followed by a sweep of that low, and only then a counter-trend rally that convinces people the worst is over. That rally doesn't mark a new bull market. It marks the midpoint of a larger bear structure. It's designed to reset sentiment, trap late optimism, and create the conditions for the final leg lower. That's how markets maximize participation and minimize consensus. Easy paths rarely get chosen. This is why price zones matter more than narratives right now. The 200-week moving average has historically acted as a magnet during midterm years. It doesn't guarantee a touch, but it demands respect. As time passes, that level continues to rise, compressing the range where price can realistically stabilize. That's why targets like the 60 to 70K region aren't emotional guesses. They're structural references that align with long-term trend mechanics. Whether price reaches that zone through a fast flush or a slow bleed is secondary. The market's job is to force the maximum number of participants into discomfort before it resolves. What complicates this cycle further is the absence of a traditional altcoin excess. In prior bear markets, Bitcoin punished reckless speculation elsewhere. This time, much of that speculation never fully materialized. That means the unwinding process doesn't feel explosive. It feels dull. But dull markets are often the most dangerous for underprepared traders because they slowly erode conviction. People stop paying attention. They stop researching. They stop planning. and that's when opportunity quietly starts forming. If this structure continues to resemble 2019 more than 2022, then the path forward is unlikely to be dramatic in the near term. Expect lower highs, intermittent rallies that feel promising but fade, and extended consolidation that makes time itself feel like the enemy. That's how markets extract the last remaining patience from participants. And by the time the majority becomes fully convinced that nothing is going to happen for a very long time, the conditions for reversal are already in place. The irony of bear markets is that the real money is never made during excitement. It's made during disinterest. It's made when headlines stop moving price. It's made when conviction replaces emotion. People who built meaningful positions in late 2022 didn't do it because it felt good. They did it because they understood cycles and respected structure. That same dynamic will repeat, but it requires enduring this phase without needing constant validation from price. Another factor that can't be ignored is macro inertia. Over the next several months, the backdrop remains largely unchanged. Interest rates are still restrictive, equity markets remain elevated, and there's no immediate catalyst forcing aggressive easing. Without a shock, liquidity conditions improve slowly, not suddenly. That supports the idea of a prolonged grind rather than a sharp reversal. Markets don't move simply because people want them to. They move when conditions force capital to reposition. That doesn't mean there won't be rallies. There will be. There always are. Counter-trend rallies exist to confuse, not to confirm. They give people hope at the wrong time and despair at the wrong time. A rally into early 2026 would not invalidate a bear structure. In fact, it would likely reinforce it if that rally stalls below key resistance and forms a lower high. That's how trends persist while tricking participants into thinking they've ended. What matters most right now is perspective. This phase feels uncomfortable because it lacks clarity, not because it lacks opportunity. If you're waiting for universal agreement that this is a bear market, you'll likely get that confirmation near the end, not the beginning. By the time everyone agrees, the market is already preparing to move on. That's how cycles punish consensus thinking. This isn't the first bear market, and it won't be the last. Each one feels different on the surface, but identical underneath. They test patience, conviction, and discipline. They reward those who respect time as much as price. And they remind participants that markets don't exist to entertain or reassure. They exist to transfer value from the impatient to the prepared. If this truly is a classic case of bear market blues, then that's not something to fear. It's something to understand. Apathy marks progress, not failure. It signals that emotional excess has been drained, and that the groundwork for the next phase is being laid quietly. You don't fight that process. You observe it, respect it, and position accordingly. The key is not trying to predict exact bottoms or tops, but recognizing where you are in the cycle and behaving appropriately. Trade the market you have, not the market you want. Accept the phase, respect the structure, and remember that every cycle that creates generational opportunity first creates extended periods of doubt. That's not a flaw in the system. That's the system working exactly as intended.